Hello everyone, Dr. Stock. In this video, I'm talking PCE. I want to take a look at the data that we got in January for PCE and talk about how I think that plays out for February, being that we're pretty much at the end of February right now. What does that look like for next month when we get February's data? I think I'm onto something and I want to share that with you in this video. Down in the description, there's a link for Moomoo, and if you click that link, you can sign up and get up to 17 free stocks by opening an account and depositing some money. For $100, 7 free stocks. For $1,000, 17 free stocks. And among those stocks are 2 AI Play stocks, AI and BBAI. So check out that link for Moomoo down in the description. With that said, I am Dr. Stock, Doctor of Education. Let's get right into the content. So there's 2 words I want you to know: rubber banding and confluence. And I think that both of those things were going against us going into January's PCE. So I've been really mulling this over, looking through the data, doing some background research, and really trying to shape my perspective for a better look at what's coming for us when February's data comes out at the end of March. So stick with me. We'll take a look at the charts, and hopefully you see what I see. You can always let me know down in the comments what you think. So one of the first places I want to draw your attention is for November and December's data that we have. So this negative 0.2, negative 0.1, and then 1.8, and then this negative 0.3, negative 0.3, and then 1.1 for January. And while looking at the table might make some sense, yeah, we went down, so then we came back up. That's the beginning of the rubber banding that I'm talking about. Take a look at this chart, and you can see some of the rubber banding that we have. Now, you can imagine a nice smooth curve going through here, and any time that we break that smooth curve, such as where we drop down here, we sort of rubber band back up to come back to the path that we were on. And when we stretched up to this point, we rubber band back down, keep going. So this is the real personal consumption expenditures by major type and product. And again, back down, and then we continue course, and then you can see the major rubber banding that happened during the pandemic. So what does that rubber banding look like for January for real personal consumption expenditures? Well, here's October. November drop, December drop, and then rubber band right back to this course that we had going on. So with those expenditures, some of that rubber banding that we saw, I think, is part of what led to the higher prices that we had in the charts. Now, about confluence, that's the other thing that I want to talk about in this video. So first, pay attention to this early part of the chart where we're between negative 0.1 and peaking up as high as 0.4. But for the most part, most of our dots are staying right between 0.1 and 0.2%, which is that approximate 2% that the Fed is talking about for getting inflation down to 2% annually. So 1% annualizes to 1.2, 2% annualizes to 2.4, and so as long as that evens out to about 2%, the Fed is good with where we're at. Unfortunately, when you look more recently, so this far right-hand side, this is post-pandemic. As a matter of fact, you can see the bottoming out during the pandemic. We sort of went back to where we were, although a slightly higher middle. And then since that time, our baseline, besides going June to July, which again, confluence is part of that rubber banding that we have happening. Otherwise, we've been between everything from 0.2 up to 0.6 with high concentration of 0.3. And so a middle for this is more like 0.4, maybe down to 0.3 for where we'd find those middle values. And I know that I showed that numerically in my previous videos on PCE. However, I think it makes a difference to look at it graphically. Now, I did mention the word confluence. Confluence means that things are working together. So one of the reasons that we have this high read that we did in June is a confluence between a few things. So let me take that down, and I'll bring up durable goods, and I'll also bring up non-durable goods. And I know it looks like a mess, but what I want you to see is just a little bit of the direction on the screen that we have, that when we come back to March, which is an even peak with what we had in June, we did not have confluence. We were way up for non-durable goods. However, we were down for durable goods, and so that evened out a little bit for us. However, when it came to June with the high print that we had there, we had confluence between non-durable and durable goods. And what do I think was behind all that? So let me take both of those things down and bring this one up. When we look at energy goods and services, whether it's included or excluded, is still a major driver of other prices that we have in our economy. So that's a big thing to recognize. And when you look at the prices that we had for March and the prices that we had for June, or the percent increases that we had month over month for those values, they were just enormous. And what did they look like when we looked at PCE? Now, if we go all items, you can see those two high peaks that we have at 1%, which would be 12% annualized inflation. And you can also see a major drop that we had going into July when those energy prices came back down. As a matter of fact, I can put this back up here. And there's such a big difference, it kind of squishes the line a little bit. However, you can see the uptick that we have in March, and you can see the uptick that we have in June, the big drop that we had in July, and then also as a result of the big drop that we have in energy prices, we pull back down in July as well. And so even if we put that up against PCE, excluding food and energy, you can still see the rises and falls, even though I know they're tiny on the chart here, because there's influence from energy goods and services with the other prices that we have that are measured by real PCE. Some of that confluence that we were talking about then would be when we have rises that go together or even falls that go together. So when the movements go together in the market. So let's put up durable goods real quick and non-durable goods. And you can see for January, durable and non-durable both moved up. There was confluence there. And when we go back to October, non-durable goods were up, however, durables were down. And when we go to November, they were both down. Both durable and non-durable goods dropped. And then when we go to December, we start to see durable goods start to move back up, but non-durables, they tick back up a little bit, but still, and they're in that negative percent territory. It's still a bit of a drop, just not as much of a drop as before. And then in January, they both went positive. So causing just a big difference between what we had before. However, you can see that we are peaking out a little bit, just like we did in October. And you can see these other minor peaks that we have before we come back down from where we're at. So we are in a more volatile period, a little bit more whippy, but that gives us a little bit more knowledge over what to expect. So if we put up excluding food and energy, there we go, and put up all of them, you can see besides the peaks, the highest peaks and the lowest valleys that we have, we rocked right around that 0.1 to 0.2%, and more recently, everything between 0.2 and 0.6, so that 0.3 to 0.4 is sort of our new middle that we're at right now. And we, in January, are pretty much at the top of that right now. So follow me on this. If energy prices were such a huge driver for other goods and services that we have throughout our economy, and the energy prices have already moved back up significantly from where they were at from December to January, but have not moved significantly from January to February, then that could be a big clue to us that there hasn't been a huge change in price. A huge rise is the one that we're worried about most, a huge rise in prices from January to February. So we have goods prices, which have made a rather decent jump up after trailing off for 2 months and then rubber banding. And then services, we also have somewhat peaking from what we've seen in the pandemic so far, actually leveling off from what we've seen in the pandemic so far. So goods peak, services leveled. It's possible that we don't get that much of a raise in the next PCE reading at the end of March. When we look at PCE, we are also near the top of the range right now, which means between energy clues that we have and also being at the top of the range that we are at right now, when we look at whether it's excluding food and energy or having food and energy in there, which could be a very good thing for us. Now, it is after the FOMC meeting, so it wouldn't help us for that part of it. However, it could be something that helps the markets prior to getting Q1 earnings, and we find out more about the consumer from the companies when they report those earnings. CPI and PPI do come out, however, for February. So one is on March the 14th, that's CPI. One is on March the 15th, that's PPI. And they are very much both worth watching. I do not think that they're going to confirm what we've seen in January. Instead, I believe that they're going to allow some settling from the peaks that we saw from January. I think we're going to settle in a little bit before that next FOMC meeting. And I think some of that pressure is going to come off. So the last thing I want to do is talk about then for markets, what exactly is it that we're going to see? And this, I think, is where it really starts to get interesting. So here we're looking at QQQ, and at least in the near term, I think we're sitting in a really good place for a little bit further of a rally, or at least bouncing back up from where we're at, that over the next 2 weeks, I'll put it over that 2-week span, we could possibly see a decent amount of green in the markets. And I don't know if that's going to happen, but we have stayed up above the 200-day simple moving average that I have here on the daily chart for QQQ. And I think that's going to act as a very good area of support for us. And I think that we could find a little bit of resistance on the way back up. So about 1 to 2% back up from where we're at. Maybe we hesitate a little bit. But honestly, depending on how good the news is that we get between now and the next CPI report. Now, mind you, there could be some worry or fear or doubt over the next CPI report. We still have room for a rather significant gain from where we're at right now. So let me see what that is. So $10 up would be 301. So $22 up from there. So that would be, we have room for like 7% from our current closing price up through when we get those next reports. So while I think that we're not out of the woods yet, and there are things to worry about in the world and in the markets, I do think that we'll actually experience a little bit of slow drifting upward for this leading up to the CPI and PPI reports that come out. And I think we're going to have rather pleasing results from that. So we're going to have to watch and see as they come out, and I'll put out more videos on them as we get closer to those dates. I do already have an early view of my CPI over at the Patreon, so you can check that out and let me know what you think of it. I plan to update that very soon, especially in light of this most recent PCE read that we got and some of the updated perspectives that I have since looking through more of the data. Now, there's two really interesting things that I think of when I look at the SPY here. One is this channel that we seem to be trading in. So off the lows, we seem to have a nice little line, a diagonal of support, and then off the highs, a nice little diagonal of support. So I was actually really pleased to see the SPY come back down from where it was at from that previous peak. So it does make things a little bit cheaper for us. It did fall down below its 50-day simple moving average. I think as long as we stay up above the 200-day simple moving average, above that 50% retracement level from peak to trough, I think we sit in really good shape. And I think we actually have some really sturdy support happening right at about that 200-day simple moving average. So we want to watch that. And I think, again, it is possible that we start to see some levity come back to the markets over the next 2 weeks. So let me summarize. PCE, I think that we're at the top of our range for month over month. And I think we stand to pull back from where we're at because of the whole rubber banding and confluence thing that I talked about and energy prices influence on that. And I don't think that there was a large change from January to February. So even though we might get some upward pressure from that, I don't think it's enough to move us up another 0.6%. We're going to have to watch and see as that plays out whether or not I'm correct on that one. I believe that January has corrected our course from the trailing off in real PCE that we saw from October through November, December. And so I think with the adjustments in, this could be a really good report for us coming up at the end of March when we hear about February. And we have some early views of that with the CPI and PPI in the middle of March when they come out. So thank you guys for watching this video. If you want to hear more of my commentary, check out the link down in the description to see my Patreon exclusive content that I offer. Also be part of my community over at the private Discord and interact with me and the community. We'd absolutely love to have you over there. Also, don't forget about that Moo link. Click the link down in the description, sign up, get your free stocks, and you know, it helps you, it helps me, and I would absolutely love to be able to be here and bring more content to you all the time. Thank you guys for watching. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.